Hi, my name is Marina Mayo, and I will be talking to you about private placement offers and memorandum, term sheets, and due diligence. A private placement offer is a private transaction sale of stock, shares, or bonds to specific selected or chosen investors or institutions instead of on the public open market. It is typically for when a company wants to raise capital for expansion. The investors usually invited to take part are mostly wealthy individuals, banks and other financial institutions, mutual funds, insurance companies, and pension funds. Private placement programs are also used by companies because there are relatively few regulatory requirements. These offerings don't have to be registered with the U.S. Securities and Exchange Commission. Private placement sales are commonly used for startups because they let the company obtain the money they need to grow. Some advantages to private placement offers are avoiding the full glare of public security that accompanies an IPO. Also, it is very helpful for companies to not have to disclose financial information in private placements and not be regulated like they would when publicly selling on the open markets. Avoiding these regulations and annual disclosure requirements allows a company to avoid the time and expense of registering with the SEC. Creating a speedier process. If a company is using private placement to offer a bond, doing it in a PPO allows the company to avoid the time and expense of obtaining a credit rating from a bond agency. A small company is able to handpick their investors they want involved, who have compatible goals and interests. Some disadvantages to private placement offers is that the buyer can be much more demanding. Buyers of private placement demand higher returns than they can get in the open markets. The additional risk of not having a credit rating can impact a private placement buyer because they may not want to purchase a bond if it isn't secured by a specific collateral. An investor in the private placement program may also want a larger percentage of ownership of the business when making these transactions. A privacy placement memorandum is a legal document that is provided to prospective investors when a company is selling stock or securities in a private transaction, and the securities are not registered under the applicable federal or state law that it must be registered to during a public transaction. It describes the companies selling the securities, the term of the offering, and the risks of the investment, along with other things. The private placement memorandum helps provide documents to their selected investors to ensure the investors are given high-quality information and a professional perception of the company. When it comes to private placement offers and memorandum, due diligence is really important. Due diligence for a private placement is a process where investors who are involved in the transactions can evaluate the potential of the investment and analyze and verify the information given by the issuer. Due diligence is an important and fundamental part of the investment process. All parties involved in the process of transaction should be sure to have all research and information readily available so that the investors can make an efficient and informed market investment decision. Issuers who are not willing to talk about the details of their business, even when under the protection of a non-disclosure agreement that an investor may be willing to sign, should be treated with great caution by potential investors. The next important topic when it comes to private placement programs is the term sheet. A term sheet is a non-binding agreement that sets forth the basic terms and conditions under which an investment will be made. There are some terms that are binding, such as confidentiality and counsel and expenses clauses. A non-binding term sheet can cause an enforceable obligation to negotiate in good faith. A term sheet can generally be broken down into 4 sections that include funding, corporate governance, liquidation and exit, and other legal terms. Valuation of the company, amount of investment, the percentage stakes sought, voting rights, liquidation preferences, anti-dilutive provisions, and investor commitment are some of the key terms that should be spelled out in the term sheet. Private placement transactions can be very beneficial and save a lot of time and money for a company. It also allows these investors to make a higher return on their investments. Private placement memorandum and term sheets are a big part of making these deals, and of course, nothing could be done without everybody doing their due diligence. Thank you for watching.